Good afternoon and welcome to Chicago. We are at the Cboe. This is the future of finance. Today, it's soft. It's pretty weak. The market is pulling back a bit as we have VIX slightly popping. Nothing too dramatic, but notable selling in Nvidia, notable selling in semiconductors. Not so much crypto. Bitcoin at 86 is down $1,700, which is about 2%. So nothing terribly dramatic there just yet. However, it's notable that Nvidia is really threatening 170 key line on my chart. If it breaks, that's not good. But Bitcoin holding in all right. Of course, the selling was most dramatic over the last couple months. The selling really was only existent in the crypto world. But now that we see Bitcoin holding on to recent lows, even while stocks are finally taking a hit, maybe that tells us that equities are just catching down a little bit rather than some very dramatic reversal of trend, because obviously the trend has very much been in favor, has very much been our friend. We just put in recent new highs. But as I said yesterday, the reason why I'm a bit of a stickler for the intraday charts and the candles is because until you get the record, the light holds for yellow for stocks. The record, by my definition, is at any point if you could have traded an asset, how high did it go? So intraday candles capture the entire range rather than the closing charts. And so we got all-time highs on the closing charts, but not for the candles, which is why I held stocks yellow. Now, what's interesting here is gold, baby. Gold rocks. Pun intended. One of the key winners in today's session, because there's really not much out there that's working right now. Gold, very important as a trending higher asset when there's just not a lot else that looks like this. I mean, this is just incredible. Gold, the gift that keeps on giving. Don't put coal in the stockings, put gold if you want something to make a statement. Look at this, 4,400, gold trying to break out to make all-time highs on the chart. Very impressive. If you're trading GLD, the equivalent is at about $400. So gold looking excellent right now. Volatility at 17.3 really is not too dramatic just yet. So I don't think we have to be in a panic about that, but I do think that we want to be aware if anything breaks in the semiconductor trade of note. And of course, most importantly, that is Nvidia, sitting right now at 170. Very important chart there. Nvidia needs to hold that recent low of 170. If Nvidia breaks down below 170, if Nvidia trades below it for more than a moment, look at this chart. Let me just pull up another line here real quick, because boy, does this thing really have a lot of history at this level. There it is, bang, 170. If you trade below that, then the light, I think, for my stock risk radar will have to go red. But right now, it holds yellow. Let's talk about volatility and let's figure out what's going on here with Brent Kochuba. Joining me from SpotGamma, of course, flows have generally been favorable. We were hoping for some of that expiry timing around the holiday season to help us here, Brent. But right now, it looks like it's going to be some work for bulls, too. Tell me what you see.
Yeah, Oliver, this morning we had VIX expiration 9:30, and it's funny enough, if you look at what the low of the VIX was for the last week, it was right at 9:30. And then as soon as that expiration clears, we've just seen stocks drop. Now, you can't pass the fact that stocks were looking quite big this morning. Things were looking pretty good. Tesla, 490 plus, semis were up about 1%, and then this news comes out about Oracle and problems with the financing around its data centers, and then that just spilled everything lower. And now we are really starting to press that downside. We're seeing some of the heaviest, what we call negative delta order flows we've seen in the last 30 days. What does that mean? That means people are selling calls and buying puts in the single stock space. The funny thing, or the thing that I would say is a concern, and I say this fully realizing that I've been saying, hey, those cheap upside calls, are there, we could rally, seasonality, et cetera, is we are now plumbing these lows. Single stocks, the biggest single stocks in the world, i.e. Nvidia, Google now under 300, Tesla, nasty reversal. All this is happening while vol is not yet reacting at all. And so you could take that one of two ways. You could say this is just a bounce or a move that's a tradable bounce. Or you could say the concern here is if that vol starts to pop, if people start bidding puts, then this thing is going to spill sharply lower. So it's a very tenuous spot, because on one hand you have the situation where, look, if VIX was at like 50, then you'd be like, this is a bottoming formation, we can clear some of this out. But it seems to be kind of percolating the other way. You were showing the gold chart, and you look at that gold chart and you go, looks poised for a breakout. But look at that VIX chart and tell me, like, it kind of doesn't have the same look to it, right? So that's the strange spot. Now go back to the seasonality. You go, well, do I want to buy a bunch of puts right now before we're going to hit OPEX in the holidays? And it's like, well, that's kind of a deterrent. So you look at all those charts and you say, if NVIDIA breaks this key level, and I'm with you, like you can't fight those flows. But the problem now here is vol could really break out. And that goes for these names where vol is very sluggish. And the founders note this morning went through CoreWeave down 20%, IREN down 25%, Oracle down 18%, Avigo down 23% in the last week, just 1 week. So that is really ugly. And then guess what? The vol's not popping on those things. Like you are not seeing this bid. You are not seeing that put skew steepen, which we were taking as one of two things. Number one, real money selling. And then number two, we've seen some put selling in those bigger names, the Avigos and the Oracles. But what happens when those put sellers throw in the towel or they cover and you start to get some of that bid to vol? So I fully say this, admitting, we're like leaning to the call side. I think the thing that you have to worry about right now, if you are a bull, is if the thing starts to work lower, meaning single stocks, which have no bid right now, if that vol starts to wake up, that's where you get the downside convexity, and that's where things really start to happen. That's not occurring at the moment. I'm just saying that if you are sitting here thinking like, is there a soft underbelly here? Well, that soft underbelly is now to the downside where you really have to be cognizant of that. Now, I say all that, and then you have to still worry about this weird right tail move where I think these holidays can generate like the bounce. So it's a very, very tricky spot. And I think the theme that you take away from what I'm saying here is be poised for volatility. Well, what is weird about that, Oliver? VIX is still at 17.5. We covered yesterday how the 0DT straddles are perpetually underpriced. What do I mean by that? For the last 5 days, we've seen at least 60 handles of movement in the S&P 500, but the straddle keeps being priced lower than that. For example, today's 0DT straddle, it was 32 bips. So that was pricing in hardly any movement, and we have a 1% of movement right now. So, but this is happening on a daily basis. So there is still some vol supply.
If you remember, Brent, I was with you in that my bias is positive, but I was also pointing out that maybe this is one of those opportunities where you just bet on a move, where you don't know which direction, but because the straddles are cheap, then why not, just bet that we're going to get a couple percent move by the expiry.
That 0DT straddle still buying that. And I'm sorry I continue to sort of like drone on here about this stuff. The last thing I'll just say on this, Oliver, tomorrow we have CPI is pricing about 3 vol points, with that event. We should get some contraction, assuming that's not a material number. Then obviously we have OPEX on Friday, which is one of the bigger options expirations ever. If we do get some more sharp downside, you clear out some of those puts. I sound like the broker record again, thinking that we get the Christmas bounce here, and that's obviously not necessarily coming to fruition here. But the core elements that we can say has been consistent is 0DT options have been serially underpricing vol. Vol is not waking up to the upside or downside yet, despite the fact that we've had a lot of intraday swings. And so, I think that the thing that you have to worry about here is if we get that Christmas bounce, or even if we don't, if we just sort of hold stable, there is like the potential for, I think, a lot of downside as you get into January and traders get back into their seats. And then maybe that idea of a more material directional of, vol spike / equity downside slide starts to come to fruition.
Okay. So number one is, the upside momentum has certainly faded a little bit here. It's getting a little bit trickier to kind of argue for the upside trend, but at the same time,
and the bad news keeps coming.
Yeah, and at the same time, though, we haven't had major technical breakdown. And right. I would also say that if you just bet on the move, too, it still looks fairly cheap to try and just put on a straddle or strangle or something like that. Now, Brent, if we go into SpotGamma, I've just got today's chart up here, but tell me where we should go to see some of these volatility dynamics that you're talking about here.
Yeah, if you go to, you can go to the volatility dashboard there.
Okay.
And then if you just hit volatility skew, what that's going to show you is 1 month S&P skew, right? So what is 1 month implied skew, or what's the skew for 1 month to expiration options in the SPX? And that shaded cone is the 90-day range for SPX skew. So S&P is down 2%. And as you can see, that skew for at the money option, so basically where the market currently is basically at its lows. It's really barely off the lows. So if you think about what happened in November, for example, in October, where VIX went over 20, 25, right? And that vol really started to wake up. we're sort of at that crux right now where you go, okay, like what's going to make vol shift from the bottom of that cone, right? 17% implied vol to like 20% implied vol. You start to you need a bid to volatility. You need to start to see what seems like a suppressed level of vol start to shift. And if that happens, that's where you start to get kind of the cascading downside, right? That's where you start to get a -2, -3% down day. And so, that has to be the worry at this moment as the equity bid is just not materializing. The thing I think keeping it contained is that lack of volatility there. Now, if you look at those deep out of the money options, I mean, you got to go way down below 6,200 to argue there's any sort of steeping of skew, meaning a bid for puts. There's really not. I mean, those options you're highlighting there are so far out of the money that they're not necessarily in play.
These are YOLO puts down here.
Yeah, very, very far out of the money. So, if there was people buying put protection for January, you would see that skew lift, right? You'd see that teal line move to the top of that cone, and it's just not happening at the moment. There's not a bid to calls either, as we've highlighted, time and time again now over the last several shows. But the core takeaway is that vol is just very sleepy, and the pricing of implied vol, look, a 17% implied vol, which is what that's showing, is basically pricing in 1% at the money moves, right? And that's essentially all we're getting. So there's no vol premium because we're moving 1% a day. It's 1% down, 1% up. So again, there's no risk premium in the market at this point. And the problem for bulls here is if the volatility premium starts to shoot up and people start to buy VIX calls. If you look at VVIX, you'll see it's not doing anything. The nation skew index, not doing anything. So, there's all these indexified measures of vol that are saying the same thing. It's hard to get a material bounce in the market and say this is a concrete bottom if that vol's not getting bid, right? And so, that's it's just a very tricky situation. Yeah.
There's no panic. So, Brent, I mean, maybe then, based on what I'm hearing you say, and then also based on the skewness in your volatility dashboard, is it crazy if you are looking for a YOLO play, if you got a YOLO in one direction, then to go for the downside like deep puts, if everybody's kind of thinking, all right, Christmas we finished strong, supportive holiday flows, all that. If you're the gambling type, if you're trying to go for a quickie, maybe there's some merit to that.
Yeah, and the thing with like the expression of upside calls last week was the options were so cheap. So you're buying a 9% implied volatility on a call. You could buy upside call flies in the 7,000 area for a couple dollars each, right? Very, very cheap. Very good risk reward. We're talking about Kelly betting, for example. In this case, you say, I know there's a week of decay coming up, so I would be looking at February or March put spreads, and the vol is not very expensive. So if you put the put spread on for, say, Feb or March, the carry of those is not terribly rich, right? It's not terribly high, right? Because there's still a lot of time to expiration. And that vol is not very elevated at the moment. And so you could add those positions now, and they'll carry fine through the end of the year, obviously, because they're longer dated. And if the market does start to spill over and vols finally starts to react, then those are going to pay really well at this time, right? The vol is not very expensive at all, and there's not a whole lot of compression there. So, when you're thinking about the downside and you're saying, okay, we're going to give up on this idea of a Santa rally, I think those Feb or March expiration options, 25 delta options. So you're looking at 6,500 area strike, 6,300 area strike, depending on where you go, Feb or March. Those kind of 25 delta options and putting on a put spread, I think make total sense if you want to hedge that downside. And I think that as long as the S&P is under 6,800, you gotta be wary of that right tail, right? Or excuse me, that left tail move, that downside move. Yeah.
I respect
if we get
that.
over 68, that's the right tail.
No, I respect that, because this chart did kind of, you had this uptrend line. It's a little bit of a wobbly one, but look, it goes pretty good back to, the spring, basically, since we came out of the tariff sell-off. This thing has held pretty well. Despite that violation in November, this is now kind of another break below that. Obviously, we had that big move in November that was the bottom where you did have that corresponding spike in VIX. To your point, we haven't seen that yet. So until we do see some kind of big spike in vol, I think this just comes back to our point that we've been talking about, which is no matter which direction you think this is going to go in, it's fairly cheap to express your view. And I think if you get it wrong, you won't have the market to blame. Sometimes you do have the market to blame. You can go, all right, I got the move right, but the premium was too much or whatever, and I got, the juice was already squeezed or whatever. In this case, that's not the situation. In this case, if you get the move wrong directionally, then you just got it wrong. Because if you get it right now, you're going to get paid very well because it's pretty cheap to speculate still. And I think that makes for a fun market from here to the end of the year.
Yeah, and you're talking about a situation where there's possibilities in the positioning. To say there could be a sharp rally just because of a technical indicator, that's outside of my pay grade. But I see the events that can contract vol. The same thing to the downside, right? If you're going to pop NVIDIA below these certain levels and there's negative gamma at least down into 6,600 now, and you're going to say, well, what is vol pricing? You're like, it's not really pricing in that kind of a move to the downside, but that is that's on the table, right? The positioning supports that kind of a move, another, let's say 3 to 5% slide lower. Well, if you price that into the market, then suddenly those Fed puts look cheap, right? They're not that expensive. And so, that's the situation. If the puts were, VIX was at 80, I would not be sitting here saying, go buy February 25 Delta puts. Like that would just be, that wouldn't make much sense, right? So, it's the combination of what is on the table in terms of positioning, and then what does it cost to express a trade or an idea. And right now the vol is very cheap. So pick the upside, picks the downside. Either can make sense. And you can structure, I think, some pretty good risk reward trades, given that things seem at a crux here, right?
And that's what it's all about, right? It's about risk in the reward. That's why we monitor the flows. That's why this is a really important part of, I think, being a trader today is understanding, where the machines are pointing. It's like, it's I always like to make a poker analogy. For poker, it's about picking games. It's about finding rake, low rake games. Identifying when there is an overlay, let's say in a tournament, right, where there's a guaranteed amount, but it hasn't been met yet. That's a great time for you to play. So all these things are giving us kind of ideas on the fertile nature, whether or not the market is fertile or not. It's very fertile for trading right now with VIX and volatility as low as it is. So if you got a hunch, bet a bunch, basically. I'm not getting paid to say that, by the way. There's no broker sponsor for this show at this point.
And they're not coming in now.
Yeah, exactly. Okay, so look, I think point is vol is low. Pick a direction. Don't be afraid to use a spread if you want to go deeper out of the money for something. Expiry, one last thought there, Brent, on kind of when maybe we should expect. I mean, do you think by Friday we should be getting a kind of washout move one way or the other?
Yeah, I mean, the window for being long puts is like, it's going to get a little painful for short dated puts next week, particularly, right? They get half day Wednesday, OPEX Friday, and then Christmas on Thursday. So, you start to lose that downside momentum, and you're going to clear out a lot of downside positions. So if you get more energy to the downside, then I think it's going to be harder to sustain that energy through Christmas. The weird scenario would be like, what if the market is being supported by the flows we're talking about, and so we're not spilling over because of the flows we're talking about. So instead of not getting a bounce, we're just getting support, right? And then once that Christmas period goes away, then we really spill over. So, there's that weird other angle where, yes, the call for the big Santa Claus rally didn't happen, but there's this sort of implied support based on the clearing of positions and the Christmas holiday. So this is why we're sort of saying, like, it's a hard market to spill over, because what happens when you clear out positions and then you have the market close, like you lose that downside momentum, and that vol can't quite sustain, it needs energy. And when you close the market, it loses some energy. So that's why it feels like the window is not quite ready for the kind of capitulation move. But you have to respect the fact that stocks are no bid and news just keeps getting worse. Again, I point back to the Oracle news this morning, which really just sort of reversed all of these, Mag 7 names that drive the S&P.
Yeah, I think we can trace a good bit of this back to Oracle's earnings breakdown, frankly. Broadcom pulling back as well. NVIDIA
and literally this morning you saw that news come out pre-market with Oracle's Michigan data center, and it just slammed things, and they just couldn't recover from there. And it was a real reversal of momentum for these big stocks.
That was the potential wrench in the situation, was if Oracle or any of the big earnings missed. So, we did kind of get a heads up that maybe that would be the cue. Appreciate it, Brent. Good stuff. Thank you, sir.
Thanks, Oliver. Take care.
Yeah, you got it. Nice work, Brent Kochuba, SpotGamma. Quick innovator buffer break. Then I got Danny Kirsch from Piper Sandler joining me. Always a great trading mind as well. Be right back.
What do you think, market? I didn't read your note yet today.
Joining me, there he is. Welcome back to the show. Danny, how are you, sir?
Doing well. How are you?
Doing pretty good. We got a market pulling back, obviously. You heard Brent's take there, and I think kind of fairly consistent over the last week has been basically, if you got a hunch, bet a bunch, volatility's cheap. Tell me where your hunch is pointing you.
We got CPI tomorrow. It seems like the way the market's trading that I'm not sure what could come out tomorrow where people would take this as super bullish. The Jan hikes or the Jan cut, that's already gone. So if it comes in light, I don't think it really matters. And the vibe I get from we're speaking to clients all day is that they're not very happy and not set up at all for a sell-off. And the market trades so poorly on days like today, where I heard Brent talking about this earlier, and he's 100% right. We sell off, volatility doesn't go up, and that tells you degrossing. And that's like an ugly setup. And you want to see a bid to volatility to start to get a little more constructive on the market, and we're just not seeing that. It's like if I just looked at what volatility was doing, I'd think we were flat today.
Right.
And I think that whole, it's not doing anything. And so that to me is like, it's not even complacency. It's that I'm losing money. Okay, well, I'm just going to sell my stocks and get out of my hedges and just move on. Like I'll get back into it in January. And that seems to be the vibe I'm getting, or I'm not really putting anything on right now, or I just want to see how my stuff goes. And I get that. And then the other thing that sort of happened is that breadth is actually not bad. Most of the S&P is actually up today. Yeah. Energy's trading well. Financials are trading well. Staples that no one is long, those are trading well. So there's certainly an offsides. You see momentum getting wrecked today, and the momentum's been getting wrecked all December. That's not unusual either. Momentum does tend to underperform in December, and so it's like all these things are sort of happening amidst a very low volume tape.
Energy up 2%, real estate up 0.5%, materials, staples, banks, all higher.
Outside of banks, is anyone long any of those sectors?
By the way, Danny, regional banks are like sitting very pretty right now after a pretty good move, which is kind of an interesting sort of like sidebar there.
Yeah, I mean, we like regional banks into next year. I think that's sort of like it's almost like a delayed winner. Like last year, everyone liked it long. We've been sort of pitching it for a while, and the thought is that there'll just be a ton of M&A. And if you're looking at one sector that'll win on deregulation, it's regional banks. And again, typically an unloved sector. We like large banks too. Mind you, we have a big banking team here. We have a lot of banking research, so we're very bullish on the space and think M&A will be the story in regional banks next year. There's probably too many regional banks in the United States. We think there'll be a lot less next year as part of this M&A sort of spree, and regional banks being a big winner there.
Okay. Chart that had been very range bound, basically kind of breaking out. XLF, similar in nature, but a little bit of more negative chop just in the last couple weeks. I want to come back to your general point real quick, Danny, which is important, which is that buying downside protection in a rush to own puts is different than someone just saying, all right, I'll sell the stock that I got and move on. And I think that's particularly interesting from your institutional perspective at Piper and the clients that you guys work with, because that's something that I think is a key distinction a lot of people don't understand. So take me through that again. The difference between selling your stock versus buying a put. Why does an institution make one decision versus the other?
Yeah, I think you're adding puts, you're adding protection when you want to add long exposure, or you're panicking. And and sometime in April, there was real panic, and you had people buying puts because they were worried about further crashes. Right now, oftentimes we'll see people start adding protection. It's not even necessarily bearish. It's actually a little bit bullish because, again, they want to gross up exposure. That's just not this. It's not this time of year we don't really see that, and that's just not what's happening. It really feels a lot to me like the end of 2018. Again, we're only down a few percent off the all-time highs, But 2018 into the end of the year, you had every single day we were selling off, and there was no volatility pickup until Christmas Day, and that's when we finally broke. Is when the market started to rally, and I think it was Powell pivoted a little bit, but whatever it was Christmas Eve, I think, where we were down a lot intraday, and then finally volatility went nuts.
Boy,
Market rallied, and we
2018.
rallied. Yeah, we
Did I hear
rallied
you
all
right
through
there?
19.
Man,
Yeah,
you
we
guys,
rallied.
we're going elephant mode here, memory mode. 2018. I got it up for reference though. To your point, we were getting drilled. That was the October sell-off. Here, let me pull it up.
It's hawkish Powell.
That throwback there. Yeah, exactly. The very beginning of hawkish Powell,
then-
right? Kind of early,
Yeah.
early stages.
And then he
it
then he
did spike.
crumbled and cut. Yeah. And so
Right.
if that setup obviously, wouldn't be great, but again, it's like you almost to get very constructive on the market, you want to see some sort of volatility bid because that also creates like this setup for market to rally because you have what's called delta decay. And again, when a put outperforms its delta, and we've talked about this a little bit before, is just when a 10 delta put acts like a 25 delta put, a dealer who is short the put is shorting more stock. And then you have the reverse situation when we rally, where a 25 delta put will actually, the delta could shrink pretty quickly. And a dealer who's short stock will be covering that stock pretty rapidly on the rally. And again, so that's what you always want to see on sell-offs, like a big VIX outperformance where VIX goes to 40. Like we think that is incredibly bullish when it happens. Not necessarily the level of the VIX, it's just vol overreacting. And this is the exact opposite. I think options are extremely cheap. We're down 1% today, and we see tomorrow straddle like 65 bips, and you have CPI. And if the CPI, God forbid, comes in hot, what do you think happens tomorrow? Think anyone's buying tech stocks?
Fair enough. What do you think?
And we've been adding downside in like a lot of the semiconductors too, as sort of a play on some of the data center concerns. And it is interesting that you get these headlines about data centers that are immediately refuted, and the stocks don't rally at all. Like Oracle every day just looks like a broken chart.
Yeah. CPI tomorrow, what do you think is the threshold here? It sounds like you would argue very, very low pain tolerance threshold for.
Yeah, well, it's also
CPI.
weird. You don't have the month over month because I don't think we're getting October, right? I think you just have the year over year they're going to release. We think it comes in line. Our firm, and mostly because rents and housing have been cheaper. That's our argument, and also oil's been collapsing up until today. So we think it is in line, but I think in line isn't necessarily bullish enough. You just saw that with payrolls 2 days ago. I think it seems like people don't need much of a reason to sell their tech stock specifically over the next couple of weeks.
Got it. All right. Now, the notion of kind of the degrossing versus put buying, obviously selling stock can be painful if you're in the stock that's getting sold. And it sounds like that's the tech is the target for that, given the gains. But at the same time, I could argue too that that's kind of the way you want to see it, sort of the nature of beta, where, okay, if CPI comes in, no bueno, and we start selling, naturally you go for the winners. And I think a lot of these charts still have some room to breathe on that front. Obviously, there have been some real sell-offs lately, like the Broadcom and Oracle of the world. But when you zoom out still, look at one of the worst ones, Broadcom, here in the past week. This line at 320 has held still. I'll put that right there, 320, right in the middle of the gap from the earnings back in September. So to me, that's a chart still that you could argue is in an uptrend. NVIDIA, which has been horizontal for months, almost 6 months, I think that one's very concerning if it drops below 170. What are the other bellwethers that you're watching here?
I mean, as far as look at Amazon.
Okay.
That's the one name we've been actually adding a little bit to the long side. This stock hasn't done anything in a year.
Yeah,
Volatility's low for
chart.
January. I don't know. We've been buying the 245 calls for January. The volatility's low. It's like if you want to play a catch-up trade, it's up 1% this year. It's the worst performing Mag 7 name, which I think would surprise people. I think that people just generally think Apple's underperformed. Mm-hmm. And this year it's Tesla, and this year, it's Amazon. And so we like Amazon as a long into year end or into next year. Is maybe that's a rotation winner too. And one of the other things we've looked a lot at is getting long the 25 worst performing S&P names. Between Tease and Jan X, we call like the biggest losers trade, similar to the dogs of the Dow, the same sort of concept.
That's
and the thought is that these names get oversold because of tax loss selling, and in a year like this, where everyone generally has made money, on the long side, or not everyone, but people. There's been some winners, like names like Google that are widely owned, Tesla. Um, perhaps to offset some of those gains, you sell some of your losers. And we put together this list of the 25 worst performing names. We do this every year, and we look at the performance between decent January expiry. And this list is average a 7% return. 6 of the last 7 years it's been up. It's outperformed the S&P by roughly 5% over that Dec to Jan expiry time span. And
Okay.
some of these names we think could potentially have some tailwinds because there's a lot of consumer discretionary, some consumer staples, some comm services name TTD actually that as of this morning was the worst performing name in the S&P year to date, which is kind of surprising. But you have like into next year, you're going to start to hear more and more talk on the big beautiful bill and the tax refunds that are coming. So I think retail is kind of an interesting long into next year. Everyone hates it, crowded short, and if you're going to be giving people bigger than expected refund checks on their tax returns, that's a space that could turn up. And I always like being long areas where it's not necessarily things have to go well; they just have to stop getting worse. And
Okay.
those are usually okay longs.
I've actually got that for you here. One sec. Check me out. Booyah, baby. Here is the list of the S&P 500 sorted by percent change year to date. There's Trade Desk down 69%. So Deckers is in there too. Lulu, which is going through major leadership changes. A lot of consumer stuff in here. Obviously not a ton of tech, but Gartner's in there, GoDaddy, Zebra, which is kind of an interesting one with the scanners. But yeah, this is an interesting approach because, I mean, there's some pretty darn good companies here. You got Chipotle in there. Deckers was a screamer for a while. Super
Restaurant. I think
popular.
restaurants are kind of interesting too. They've all been bombed out. I get the GLP-1 story. I get the consumers being squeezed story. But again, if you're giving people money and you've got super crowded shorts, I think it's an interesting long again as a trade. Like I don't know if these are perpetual owns, but if you look at a chart of CMG or some of these other names that have actually been blown up, DPZ.
Yeah.
Um, I think that there's sort of like a tactical long, especially if you're putting money into people's pockets. And then I know Trump's speaking tonight, although I can't find anything on what he's supposed to be talking about. I
Right.
know there's been a
Make
lot of
sure
cannabis
you get
headlines.
the
I hope he's not
discounted
doing a
burrito.
9 o'clock call about legalizing weed.
Uber Eats. Well, hey, if they legalize weed and then advertise for the Uber Eats Chipotle discount, that's a pretty good bullish combo for Chipotle right now on Uber Eats. You order, I think it's $20, and you get another burrito with it. So I got 2 burritos. And, that's like 4 days of food there if you preserve properly.
I don't know if that's bullish or bearish.
It's probably bearish Oliver, but bullish for Chipotle. So, and by the way, the chart too, kind of looks interesting. Very gappy around the earnings. So maybe this thing can actually push through to $40. I like the idea of the dogs of the Dow trade the underperformers on a year that has been so tech focused. A lot of people were also looking for the rotation theme, right? The Russell and stuff. And right now, the Russell chart looks pretty darn good. IWMs. So just because tech takes a breather here doesn't mean it's the end of the world, I don't think.
Yeah, and I think credit's been acting okay. So until credit really starts to widen out, then I think Russell could act fine, and you might have a brawny. But again, if you really want to see some sort of just bid to volatility to get a lot more constructive on the S&P and on tech, and that's just again, it's just this weird sort of sell put, sell stock, degross, and maybe start gearing up for next year. It feels like a lot of that's happening right now.
Okay. Gearing up for next year, not exactly a panic, giving up of the main trade that's worked right now. Love the stock specifics. Good ideas as always. Bringing us an institutional mindset, head of options from Piper Sandler. Danny Kirsch, thank you for your time, my man.
Thanks for having me. And
You
Jared,
got it.
good to see you.
Yeah. Dylan's waiting in the room here. What a lineup today! Brent Kochuba, Danny Kirsch, and Jared Dillian coming up after the break. We'll be right back.
With increased volatility, investors are bracing for large market moves, both up and down. Will the market rebound 30%, or will we see a 30% drop? At the end of the day, uncertainty remains a constant. Innovators' floor ETFs are designed for volatile markets. They aim to position portfolios for market moves regardless of direction or magnitude. They are intended as a core equity solution, providing exposure to U.S. equities with built-in downside protection, seeking to deliver more than 70% of the upside and targeting a max loss of 8 to 12% annually. With specified levels of sought-after protection and upside participation, we believe the floor ETFs offer an evergreen strategy designed to allow investors to remain invested regardless of the market's direction. With increased volatility, investors are bracing for large market moves, both up and down. Will the market rebound 30%, or will we see a 30% drop? At the end of the day, uncertainty remains a constant. Innovators' floor ETFs are designed for volatile markets. They aim to position portfolios for market moves regardless of direction or magnitude. They are intended as a core equity solution, providing exposure to U.S. equities with built-in downside protection, seeking to deliver more than 70% of the upside and targeting a max loss of 8 to 12% annually. With specified levels of sought-after protection and upside participation, we believe the floor ETFs offer an evergreen strategy designed to allow investors to remain invested regardless of the market's direction.
Welcome back to Chicago Future of Finance. I'm Oliver Renick. We got a great guest joining me. Jared Dillian is the man, the author of the DailyDirtnap, continuing our conversation about a market that's under some pressure today. It's not the worst, but it is getting hit fairly hard. Jared, how you doing, man? Thanks for joining in the squad today. I'm doing great.
Yeah, getting towards Christmas. Looking forward to it.
Yeah, me too. What's up? People selling stock to degrossing to buy gifts?
Yeah, I mean, I think I had a discussion with Tony Greer and Kevin Muir today. We did Tony's podcast, and I'm pretty bearish on AI going forward. I think there's a lot of macro implications to that. If you look at capital flows into the U.S. going back over the last 30 or 40 years. If you look at the chart, it's an insane chart. Capital flows are massively going into the U.S., and a lot of it is because of the Mag 7. A lot of it's because of the Mag 7 and AI. And if those capital flows reverse, like if AI stocks start to sell off and people repatriate that money, the dollar is in big, big trouble. And we've talked about FX a whole bunch of times, since I've come on your show. And I think in the past, I was trying to catch a bounce in the dollar on the long side. But look, in the long term, even on a purchasing power parity basis, people go to Japan, they say how cheap it is. People go to Europe, they say how cheap it is. It's not really because foreign currencies are cheap. It's because the dollar, even after selling off 10%, is still incredibly expensive. The dollar is very rich. So.
Tell me about what would be sort of the signal that something like that is happening? Because the dollar's been a tricky one for me to figure out on the short term lately, Jared. This chart has been fairly immobile. I got the dollar futures up right now, but the bond chart is getting interesting because the 10-year has been kind of pushing this 4.2 high end of a multi-month range, like maybe it does want to make a move. How do you think about these two things related to your point?
Yeah, it's funny because I'm bearish on the dollar, but I'm actually also bearish on bonds, which are two views that can't be reconciled. But I'm mostly bearish on bonds for technical reasons. If you zoom in on that bond chart on 10-year yields, you will see that we broke a downtrend. We broke a downtrend, and you're pointing out the 4.2% resistance level. We're kind of consolidating around here. Juxtapose this with the fact that we have CPI tomorrow, and Danny was talking about some of the implications of a hot CPI. Like, we could gap above this level in yields tomorrow morning. Like, that's very possible.
So this is important, Jared, is how do you think about that relationship between yields and inflation? Because when the Fed started cutting, we had a significant period of time where they were cutting but yields were going up. I call it the bizarro bond world. Some say that's the Fed losing control. I just kind of argued that when you add stimulus by cutting interest rates in an okay economy, you're going to reprice the long end higher for growth. But whatever you argue, the bottom line is there have been some moments where that traditional assumption of how bonds relate to interest rates has been a little topsy-turvy. So my point is, if we do get a hot inflation print tomorrow, does that mean bonds sell off? Or does it mean the market goes, oh crap, Fed's not going to be able to cut, they're going to have to tighten things, buy bonds for protection if the economy is going to slow?
No, I think it's definitely the former. I don't think that's going to happen. Having said that, if you look at a chart, I'm sure you don't have this chart, but if you look at like forward 1 year inflation,
that one's gonna be a little tricky, but I can
that's gonna be a little tricky. But that peaked in April around the tariff crisis. So inflation expectations have been coming down, and we're sitting here talking about this hypothetical of a hot CPI number, but the reality is that inflation has come down a lot off the highs. It seems to be pretty stable. Even though I'm kind of rooting for a hot number to help my positions, I kind of don't think we're going to get one. I think we're actually experiencing a little bit of disinflation. So,
is it the on Fred? Do you know what it's labeled? Is it the instantaneous forward rate 1 year?
That could be it.
Let me show you the chart. Tell me what you think if this is it. 1 sec. Here's what I got for Fred there. It's been steadily downtrending, basically, 2023. This is a fitted instantaneous forward 1 year rate, hence THREEFF1. I don't know. I've never looked at this before, Jared. I've looked at 5 year forwards or something. Kind of using the bond market implied. I'm not sure if that's what this is.
No, I don't think that's it. If I saw it on Twitter the other day, I'll send it to you when we get off.
Yeah. All right. So basically, is the message here one that is concerning for growth? How do you feel that this relates generally to kind of the overall situation, Jared? Because right now, the numbers that have been coming in have been our first look at highly delayed data. And I think for the most part, they could have gone worse, but tomorrow we've obviously got jobless claims. So we get back to some of the high frequency stuff.
Yeah, I mean, you mentioned growth. I think XAI, I don't think we have any growth at all. I think growth is basically zero when you take out big tech, which is a little bit concerning. And I'm also, I'm not one of these people that freaks out every time the unemployment rate goes up a tenth. But having said that, the unemployment rate is 4.6 now. We're pretty close to triggering the SOM rule, which says that it's some, I can't remember, but it's something about the moving average of the unemployment rate. You cross above it and it triggers a recession.
Yeah, exactly.
So I'm a I'm concerned. I like I said, I haven't been concerned about the labor market before, but the job losses are starting to pick up. And if you think there's anything funny going wrong to BLS data, if you look at ADP, it's been negative the last couple of months. So.
How do we then best way to express it? I point taken on some of the macros, the bond and the dollar. I love thinking about the bond and the dollar, but they can be a little bit of trickier trades for a lot of people. Jared, is the other implicit play here then to go short the tech equities that have been leading? Then you want to reach that far? Give us our bear take for the day.
Yeah, I mean, I think that, I am short tech through puts, and you had Danny on before, and he was talking about how puts on this stuff is cheap. I do think it's cheap. I basically am long a bunch of stuff. I'm not actually net short. I'm still net long, but I have a bunch of hedges in individual names, like the names I think have the most downside. And that is Carvana, MicroStrategy, DoorDash, and NVIDIA. And also Blackstone. So those are the ones. Now I've gotten my head caved in on Carvana on the S&P ad. So,
you have, but you're not the only one. If it makes you feel better. Some very smart people have been bashing their head against the wall on that one for a while.
Yep.
I also too was I thought it was sort of a joke, but my kind of technical, the technical side of me disallowed that view basically somewhere around 110, 120 bucks when this thing started to turn around. But I've had serious doubts about the business model, but it's incredible. And now getting added to the broader index is amazing. Do you think it's worth another stab here on this trade?
Well, I don't. I think there's not much probability that it's going to do a V top and head down 30%. I think it's going to consolidate around here for a while. So I own some busted puts. I'm probably going to let them expire, and then I'll take another stab on the short side in 3 to 6 months. So
okay. Tell me about the NVIDIA trade here, because I've been watching this 171. I'm close to being with you on this trade if it basically gets any weaker from here. But I'm sort of, I oftentimes kind of am late to some of these trades because I like to see sort of technical confirmation of a break. And this line at 170 looks important.
Just to reiterate, NVIDIA is trading at 33 times sales, okay? Not times earnings, times sales. And you heard the whole Scott McNealy bit about Sun Microsystems back in 2000 when that was trading at 10 times sales. You had a whole bit about that. I mean, even if NVIDIA doubled its revenues, it's trading at 16 and a half times sales. So NVIDIA, look, I'm not an expert on technology. I'm not really an expert on what NVIDIA does. But if it breaks, it could have significant downside. And when I say significant, it could be catastrophic. It could be down 50, 70, 80%. Back when I was on the P Coast many, many years ago, we were the lead market makers for Yahoo. And there was somebody that came into the pit in Yahoo and bought tens of thousands of 20% strike puts in Yahoo out 2 years. Basically betting that the stock would go down 80%. And we kind of laughed at those trades, but guess what? All those puts went in the money in 2002, right?
Sure.
And they paid off.
Yeah. Look, it certainly has to be within one's framework, okay? I haven't become that concerned yet because I don't think the technicals have signaled the warning. I think that I'm kind of doing the old trade of if you use it, buy it, and I've been using a lot of AI. That being said, in my use of it, I've also seen a lot of its shortcomings too. You'll look stuff up and ask for support on something, and it gives you something way out of the blue. But that being said, you got to have a framework for a .com style reset of valuations. I'm not like super deeply concerned about the economic data lately, but it's a framework that I think we definitely have to be prepared for, ready to adjust for if it starts to manifest. BX is also an interesting one in there too, to kind of play a different side to it. But Master, I'm generally with you there. Just the price is already cratered. Do you think that thing's like going to zero or what? Real quick, Jared.
I don't know about zero, but look, it's a closed-end fund essentially. It's trading at maybe a slight discount. That discount could get a lot bigger. I mean, even with GBTC, if you remember back many years ago, that was trading at a 50% discount to NAV. So the discount for MicroStrategy could get a lot bigger.
Okay. All right, there it is. Jared, good stuff as always. Always a refreshing, honest take and nice transparency on what you own. Long stocks and equities on net, but shorting the names that we hit through here. Great stuff. Appreciate it, Jared. Thank you.
All right, thank you.
Daily Dirt Nap, Jared Dillian. Always a good take. Let's talk some more tech with Mr. Charles Moon joining me from Prosper Trading Academy. What'd you think about that take there, Charlie? I've been on the short master trade all year, but I feel like it's hard to try and get too, buried in it right now after the way it's dropped. But I do think that maybe some of the other stuff Jared's talking about, like if Nvidia breaks 170, we could have real problems on our hands.
I don't doubt it, and we've kind of seen that rotation out of a lot of the AI plays. I mean, if you look at retail names, you look at travel, they've been moving up steadily here. It's surprising to see when Airbnb and Expedia and, of course, Wynn, which has been flashing on my scanner lately, are outperforming names like Apple and NVIDIA. And, of course, looking at AVGO and Oracle, those two are cascading the kind of AI play, especially with the data centers. Anything tied to data centers has been getting absolutely murdered. For me, with MSTR, it's all about that single digit or the single candlestick at the 155.60, 152-week low. They break. That's just going to give more reasons for the bears to pile on. They've really given no indication that they're trying to rally. They have tried to lift. They keep getting rejected at the short-term moving averages. They've been riding this thing down since they crossed underneath these levels at their 52-week highs. So that's basically since 420. And speaking of 420, that might be where a lot of the rotation has gone into this week as well, as we see gains like exploding.
Give me some pot trades. What should I be watching these days, Charlie?
Well, for me, I always revert to specifically MSOS and MSOX. These are these are the ETFs with the U.S.-based entities. Obviously, Tilray, CGC, Cron, ACB. These are Canadian-based companies. While they may benefit from the actual news, they're not going to benefit greatly fundamentally. It's names like Green Thumb and Verano, Ascend, and Trulieve, Curaleaf that are going to truly benefit as they're U.S.-based companies. Green Thumb from, it's a local company. It's out of Chicago, Illinois. They basically dominate the Midwest. They have made really strategic moves out east and to the west. So they're pretty well positioned to expand quickly, backed by VC money as well. It doesn't help that Governor Pritzker is also kind of, getting a backhand deal, not confirmed, but certainly he's friends with a lot of the people that are involved, specifically with that company and that industry. For me, we'll have to wait and see what Trump actually does tomorrow. It was reported earlier that he's going to make an announcement and sign that executive order, and that could certainly change the landscape in a lot of different sectors. I think most notably the financials. Looking at the banks, we may see a big rush of buyers into the banks. Anytime JP Morgan or Goldman Sachs or Morgan Stanley get billions and billions of dollars in cash flow getting deposited into their accounts now, that's only going to benefit them in the long run, as they could take that money and move it around to other investments to make more money.
I gotta say, the MSOS trade, I always give you a shout for your eyes on the stock specifics, but in this case, the ETF that Advisor Shares runs. Dan Aarons, Nilla Hammond, shout out. Great swag from the Benzinga conference, one of my favorite shirts with all the different names for marijuana on it, which is a fun one. So is the idea here, Charlie, that something big is coming from the White House? So fill me in on this. Somehow I got left behind on this. But I mean, this is a unique big move. And I know that there's been a lot of false starts, a lot of hopes and dreams for the pot trade that have routinely come short. But technically, this breakout looks really interesting right here.
Yeah. So, when we talk about past presidents, Joe Biden, namely, he actually ran on that platform and never did anything with it. Trump didn't run on this platform, but he was very specific in September about reclassification, and it kind of was just dead in the water. And then just out of nowhere, he randomly mentioned it this week. And, this is a guy who, when he tends to start bringing things up, usually has some sort of truth behind it. You could see what he's done when he ran on the back of, regulating crypto or getting more involved or getting the country more involved in the crypto industry. You can see what he's done for crypto, at least early in his presidency. So this is something that's very intriguing. The reclassification is going to allow banks to be able to get involved with funding, with deposits, with business loans. And, this will realistically change a lot of the approach. This is where the FDA could truly get involved. This is where government entities could get far more involved. This is going to be great from a taxation standpoint, which obviously Trump is something that he loves or is looking to do, is generate more revenue to pay down debt. It's going to be great for our education system, for our police officers, because that's where a lot of that money is going to be funneled back into. We already do that here in Illinois. And so, right now with the sinking ship of AI stocks, people are just looking for any sort of respite, opportunity, growth, growth capabilities. The AI trade's been going on for 2 years now. So how much more growth can we really price in the near term? This is a sector that, it's not new to this country. More than half of the states in the United States of America have already legalized it. We've seen strong benefits in terms of what it's done to the state budgets. And truth of the matter is, the markets are always cycling for a longer-term growth play, and one might be dropped into their lap. Now, I don't think cannabis is going to explode like AI, but, if we could see MSOS crawl from, the low single digits, which they were at earlier, just 2 weeks ago, a week ago, and have them get into the $20, $30 range, that's a significant return in a short period of time.
I got a pretty nasty looking long-term trend line on this MSOS, but boy, if it is broken to the upside, I think to your point then, that is major, major relief, major technical reversal, because the downtrend has been yesterday Scott and I talked about the downtrend in crude oil, and I framed it as maybe the worst chart in the market, but I don't know, maybe pot was the worst downtrend in the market, possibly until now though. I mean, this is a pretty interesting long-term potential break here of the technical trend. I mean, you don't see this that often.
No, and that's the truth. And listen, I know there's concerns about inflation. That was something that you had just talked about with the gentleman before. But, a lot of that concern of inflation has to be alleviated when you do look at the downturn in crude, right? Crude is always one of the primary reasons for spikes in inflation. Well, I mean, they're now trading below 60 like Trump had promised. And I just, I don't really see that inflation is going to be able to spike up without crude being a major facilitator of that. While we may see some upticks that may cause some concern, there's nothing that's going to actually put anything on the plate for the Fed to start hiking rates. There may be a case for a pause, but even then, when we get new leadership, is that going to be the actual catalyst? Is that going to be the stance of the new head Fed? And, we talk about the AI play, something that you and I have brought up. Let's not forget the memory segment. This was a gentleman that asked you directly.
I was just about to ask you about that. Yeah.
The strongest segment in AI right now.
By the way, on inflation, I thought you were going to say that with inflation going up for the pot trade, people need a cheap vacation. to quote the dear Frank Ocean. Okay. Okay, Charlie, tell me about this last part then. Bell just ring, but I do want you to answer this question. Thank you for bringing it up, because We were in Vegas for you guys' conference. By the way, for folks watching, scan the QR code to learn more about Prosper. And I was chatting with a guy who was making us some killer drinks at the bar about how he trades. And he was talking to me about how he sounds juicy with what he was looking for, which is perp trading on memory-related, RAM-related trades that are getting squeezed by what, like all the AI demand? Can you explain to me what he's looking for?
Well, perp trades are leverage trades, and I don't know where you could get kind of leverage plays besides playing some of these leveraged assets or leveraged ETFs that are centered around a lot of these stocks. I'm sure Micron actually has it. It wouldn't surprise me whatsoever. The truth of the matter is that this is the segment that I truly still believe has been able to hold and withstand a lot of the selling. Now, Micron has pulled back off of the highs. It wouldn't surprise me if they beat the brakes off of earnings and actually go up. There's a lot of rumors that have come out in Asia that the demand is insatiable. And so if Micron starts pointing to a full year, uptick in 2026 sales, well, that uptick will lead to higher production. Higher production always equates to better margins. And again, if the demand is strong, that also could lead to an uptick in pricing, which will only increase margins. We've already seen the demand, kind of spilling into a major producer like Samsung. And quite honestly, if the AI play, which is not going away, which is a real thing, CapEx spending is still going to be there. And we only talk about CapEx spending within the United States. People don't realize how much money is being pumped into the AI and AI products out of China alone.
Everywhere else.
So if Asia is trying to get their hands on all sorts of memory components and as much as they possibly can, that's just, a part of the picture that is part of the broad picture where the entire world is really pushing for this. And for me, this is one of the segments that I truly believe is going to withstand any kind of pullback, within the AI growth sector. They may fall, but they're not going to drop like the data center plays have so far.
I see. So I think his logic is pretty good, right? He says, I'd love to long out of a chart that's going to fly due to RAM shortages from AI demands. I think there are ways to play this too. I mean, he's looking for something very juicy and leverage with the perpetual, trade on, to your point. But there are other ways to do this too that maybe are a little bit less aggro, which is like buying one of the AI, one of the data center and cooling infrastructure, the AI infrastructure plays. Those two, I think, are strong ways to express this. They've had big moves on the year. Now, obviously, you're going to have to be a little bit more, patient on that per se. But for example, we had Vista Shares, Adam Patty on. Their AIS fund is an absolute beast. Artificial intelligence suppliers. That's the supply chain, AIS. So I think there's a lot of different ways that you can kind of get your hands around this. That's up 40% on the year. So obviously you got to be a little more patient with something like that. But that would be my 2 cents on that. I'll give you the last thought.
Yeah, and again, that gentleman's looking for a perp. Well, tell him to look at MUU, which is the Drixon Daily MU Bull ETF. It's a 2x leveraged asset. Micron right now is trading higher. WDC is moving up in sympathy on earnings right now. They're not up a great amount. It looks like they're up around $10. Projected move was closer to 20. So we're going to have to wait and see what the conference call is like. That's what, AVGO looked like. AVGO was strong until the conference call, and then it sunk like a rock, and it hasn't bounced since. So I believe if the conference call comes out bullish, then MU is going to do just fine. WDC, STX, SNDK, they're going to be up in sympathy as well. But if you're looking for some sort of leverage, MUU is the play. I don't do too much leverage. I do like the MSOX. So if Trump starts to get on the podium tomorrow and says we're going to reclassify cannabis, that might be the short ripper that you're looking for here, MSOX.
Yeah, there it is. Had a move here already, but still below the recent highs, so maybe there's still some more juice to be squeezed on that one. Fun stuff, as always. Charles Moon, good eyes on the momentum, good eyes on the news flow, too, for the president and what's happening in the pot trades. Appreciate it, Charlie. Thanks, sir. All right, that's it. We're over time. Thanks a lot for tuning in to Chicago Future of Finance. I'll see you tomorrow, 2 p.m.